Howdy, hotshots. It's the Dividend Daddy, your favorite, not a financial advisor with not financial advice. Whew, this government shutdown is dragging on and on. I know I told you that I thought that it was possible that it would be the precipitating situation that would cause us to go into a recession. It seems like maybe the Fed agrees with me. People are losing their jobs in a bunch of tech companies. AI is replacing a bunch of jobs. And I've seen a bunch of articles out recently talking about how if the government shutdown drags on any longer, that it could cause a big downturn. But that's not the only thing, right? The government shutdown isn't just federal employees that aren't getting paid. The government shutdown is also the SNAP recipients. They're not getting their money right now, and that's a lot of money that's not pouring into the economy. Money that they would be spending on going out to eat, money that they would be spending on new clothes, money. Now they have to allot it to groceries. So there's a lot of money that's not filtering in right now, and it really could trigger something big. Now, will it? I don't know. Time will tell. But the Fed is getting worried with all the jobs that are lost and all the money that's not being spent. Now they're cutting rates. They're talking about cutting rates even more. And we know Trump has been a big proponent of cutting rates. And so probably in 2026, he's going to be one of the, he's going to appoint somebody who's going to be more amenable to rate cutting. And that would actually cause a potential boom in the market. So what can we see coming down the pipe here? If this stuff does trigger a recession, before these rate cuts are able to kick in, before the Fed also says they're going to quit quantitative tightening. If they're not tightening, they're easing. So the reality is we might be going into another round of rate cuts and quantitative easing, which is going to be good for tech companies. It's going to be good for startups. But initially we might be able to see a downturn. So what we need to do is we need to have some powder dry. And we need to be on the sidelines ready and waiting for a quick dip and then a quick recovery. It seems like these V-shaped recoveries are going to be the new norm. They caught me off guard the first couple times because it isn't, historically speaking, what would have happened. Now, is it possible that we just go into a big bear market and it's just a long, drawn-out downturn? Yes, it's possible. What I think we're going to see is that they're just going to flood the world with dollars. Okay, we're probably going to see inflation spike up again. The only thing that could prevent this, in my opinion, is if the Fed switched and they started saying that they were going to tighten again, because that's what we really need, right? Inflation really hasn't gone away. They like to say it has, but it really hasn't. If you're looking at the prices that we're paying for groceries, if you're looking at any kind of labor costs that you need done at your house, if you're looking at any kind of car costs or anything like that, like inflation really has not gone down the way that they say that it has. Maybe it goes down for a month or two compared to the months previous, but it's not like we're in a deflationary period. So typically what we see is that government numbers come out and, the Fed is lowering rates and stuff like that in response to those government numbers. But because of the shutdown, a lot of those numbers have not been coming out. So it may be a little bit different than what I expected. I thought the shutdown might scare people out of the market that was already overvalued. What we might see is that because these numbers aren't coming out, when they come out, when the government reopens and they come out and people see how bad they really are, then everybody gets scared and wants to come out of the market. Now, a lot of people's funds are locked up in 401ks and IRAs and stuff like that, and they're not going to be taking their money out of the market anyway. It seems to me that a lot of the money printed over the last 5-6 years is in the pockets of wealthy individuals. Now, they don't need that money, so they may not pull out of the market either. And that's why I say, even if you see a big dip, it's, in my opinion, it's a very good chance that it's going to go straight up from there, because people have seen the last couple times how it worked out and stuff like that. So they're waiting for a big buying opportunity. I know that's what I'm doing. Now, what I'm buying, right, is QQQI and KQQQ. And I'll tell you what, those have been doing a lot better for me than ULTY. So I'm definitely going to be waiting for a chance when ULTY pops to get out with all of my money. And then probably start transitioning to those funds so that I can have something that's producing a little bit more consistent, a little bit more predictable income. But what happens if we do buy those funds and prices go down? Well, the prices on those are going to go down too, but you're going to get that blow softened by the fact that it's getting income. And then all of those distributions, I'm going to reinvest until I need to take the income. So those reinvestments will be at a lower price and I'll accumulate more shares. When we saw a big dip back in April, what we saw was that it went straight back up. That's when ULTY had its big run out of the 4s and back up into the 6s. I don't think it's going to do that from here because we haven't had a big dip prior to it for it to come back up so quickly. Is it possible that ULTY goes up from here consistently? Yeah, it is, but it doesn't seem like their strategy has been making that a likelihood. But what we did see is that after a big dip, QQQI came right back to where it was. So I'm not really scared of that fund the way that I'm scared of something that's got a lot more risk like ULTY. I just see ULTY just languishing. You know, it's not going down super fast, but it's not really going up or going sideways either. It's just going down at the same rate as the distributions that we have been getting. Maybe a little bit more some weeks, maybe a little bit less some weeks, but it's just been consistently going down. So it hasn't been paying me the way that I want to be paid. Now, does it have an 80% to 100% yield a lot of times? Yeah, it does. But as I've said before several times, people will say, oh, as long as it pays over 10 cents. Oh, well, then next thing you know, well, as long as it pays over 9 cents. Well, as long as it pays over 8 cents. It's not going to continue doing that. As long as it's going down, the yield is going to stay relatively stable because that's what they want to advertise. But the amount that it's paying out is going to go down, which means that the yield on your original investment is going down. So it may have an 80% yield, but that doesn't mean that it's going to be 80% on the money that you invested. It's going to be 80% of whatever the current price is. And so that means it's going down, down, down. And that's what I think we have seen. So that being said, my QQQI, my KQQQ, they're paying me and the fund is going up in addition to that, right? And so over time, that's what I want to see. Now, if I could get ULTY to go down by 60% while it's paying out 80%, so I'm getting a 20% yield, that still sounds pretty dang good to me, but that's not what's happening. But in QQQI, I'm getting my 13.9% distribution, and my funds are going up too. Now, I also was investing quite a bit in SCHD originally, right? Before I even got into these higher yielding funds, I was putting money in SCHD because it had a respectable track record. But what I've seen lately is that it's going down and its yield isn't that high. And so I might even start transitioning out of SCHD to these higher yielding funds as well, because I'm just not getting the income that I expect off of it. And I'm not getting the performance that I expect out of it. And every month that I leave it there, I'm missing out on gains that I could have had in these other funds. So I'm probably going to start transitioning out of SCHD, transitioning out of ULTY, and going more into QQQI and KQQQ and JEPQ, and even JEPI has been doing better for me. And I need to build my GDXY position too, because it's been a consistent payer. So just because if you got into ULTY, right, and it didn't work out that well for you, just know that that's not the only high yield type covered call fund out there. You still have other options. Other options on options generated income within ETFs. So don't throw the baby out with the bathwater. Start looking at some of these other things, and maybe they'll be right for you, even if ULTY wasn't right for you. Okay, D-Gens, I'll talk to you later.